Good morning, hunters, and welcome back to the Daily Hunt for Multibaggers. It's Saturday, November 29th, 2025, and we're here to break down all the market insights from yesterday's online activity.
That's right, Ethan. Our AI dug deep into quite a busy day. We're looking at a significantly higher volume of posts, 67 hot leads to be precise, which is a big jump from earlier in the week. A lot of different stocks were flagged, mainly in the tech and finance sector.
Absolutely, and the overall sentiment out there feels pretty intense. We've got some strong bullish calls on companies, but also some really sharp concerns, especially around the ever-present AI chip competition. It's a mix of promising prospects and some undeniable high-risk situations.
So let's jump right in. First up today, we're talking about Advanced Micro Devices, or AMD.
Yeah, AMD. It's been a name we often see. From the data we analyzed, there's a strong undercurrent of concern about Google's Tensor Processing Units, or TPUs, potentially disrupting the AI chip market. This, users believe, could really shake up GPU manufacturers like NVIDIA and, by extension, AMD.
And that's exactly where my red flags pop up, Ethan. While AMD is a strong company, its overall assessment is heavily bearish today, with a sentiment score of -7. The PE ratio, for instance, is an exceptionally high 113.89. That's a lot of future growth priced in. Couple that with a debt-to-equity ratio of 6.366, which is extremely high leverage, and a beta of 1.913. That beta means it's super volatile. If the market, especially the AI chip sector, takes a hit, AMD could see a much larger percentage drop. We've given AMD a stay away rating quite a few times in the past, and it seems those concerns are only intensifying with this new TPU threat.
It's true, the historical data has been pretty consistent there. Even with news of analyst price target increases, the competitive pressure seems to be weighing heavier on community discussions right now.
Precisely. For AMD, our AI-generated insight is stay away. The high valuation, coupled with significant debt and market sensitivity, makes it particularly vulnerable to the ongoing competitive threats discussed by users.
All right, moving on, we have a new name in our discussion today, CME Group, CME. Now this one's pretty wild. Users are talking about CME literally yeeting all futures because their data center got too hot. II literally cooking the markets now, was one quote. It really highlights the increased demands on infrastructure.
And it highlights operational incompetence, Ethan. The sentiment is heavily bearish, a -7. Users are accusing CME of everything from a lack of redundancy to outright market manipulation, especially concerning silver prices. While news reports say the stock price remained steady after the outage, that doesn't mean the underlying issues aren't serious. Their revenue growth is actually negative at -0.03, and their debt-to-equity ratio is a staggering 13.37. How are they going to invest in the critical infrastructure upgrades needed when they're already high leverage and not growing revenue? This isn't just a glitch, it's a systemic concern about trust in critical financial infrastructure.
You make a strong point, Brooke. The long-term impact on trust could definitely be a drag, regardless of the immediate stock price reaction.
Exactly. For CME Group, CME, our verdict is stay away. The operational failure, coupled with negative revenue growth and high debt, raises significant concerns about reliability and future financial flexibility.
Up next, we're talking Intel Corporation, Intel. Now, this one has had quite a day. There's been a huge buzz around news that Taiwan raided a former TSMC exec's home who's now working at Intel in a trade secrets probe. The market literally jumped on this, hoping he took something good. Plus, rumors about Intel fabbing for Apple are swirling. Users were saying Intel up 4.5%, and call holders made huge gains.
Ethan, that's pure speculation driving that movement. While the sentiment is strongly bullish, a +8, it's not based on fundamentals. Intel's PE ratio is an astonishing 676.00, and its earnings per share is a paltry zero point zero 0.06. That means the market is pricing in an insane amount of future success that simply isn't proven. The stock is also near its 52-week high, meaning all this potential upside is already baked in on a rumor. We've consistently rated Intel a stay away in the past, and this current surge, while exciting for some, is based on unconfirmed high-risk events.
I hear you. The numbers are definitely stretched. It's certainly a high-stakes bet, hoping these rumors translate into real profitable breakthroughs.
Indeed. So, for Intel Corporation, Intel, our AI-generated insight is stay away. The stock's current price is driven by extreme speculation and carries a very high valuation risk with little fundamental backing.
All right, let's talk NVIDIA, NVDA. This one always sparks a debate. The initial post was pretty bearish, suggesting Google TPUs put NVIDIA and OpenAI at risk. But the comment section, Brooke, was a fierce defense of NVIDIA. Users highlighted its comprehensive ecosystem, CUDA dominance, the vast developer community, and the sheer, almost infinite demand for their GPUs. There are still long waiting lists, and some users argued that TPUs are years behind for general use. It's why the sentiment came in as neutral to slightly bullish, at a positive too.
And while I appreciate the enthusiasm for their ecosystem, Ethan, we can't ignore the KPIs and the potential for future headwinds. NVIDIA's PE ratio is still a high 43.81, reflecting significant growth expectations. But the most debated KPI is their incredibly high net profit margin of 53.01. That's phenomenal, but it's exactly what the bearish arguments target. Will cheaper alternatives like TPUs eventually force those margins down? The stock is also about 16% below its 52-week high, suggesting the market is already grappling with some uncertainty. We've seen NVIDIA bounce between buy and stay away quite a bit recently.
It's a tough call with NVIDIA, I'll admit. The demand is undeniable, but the competitive landscape is evolving rapidly.
Exactly. For NVIDIA Corporation, NVDA, despite the strong ecosystem arguments, our analysis is to stay away. The high valuation and exceptional profit margins are vulnerable to the ongoing competitive threats, and the current price doesn't offer enough margin of safety given the potential for future margin compression.
And finally, we're doubling back on Meta platforms. There were actually two different angles in the data today, which is pretty interesting. One discussion was all about confident users expecting Meta to hit $800 in Q1, calling it a no-brainer thanks to strong fundamentals and rewarding long-term holders. That sentiment was very bullish, at a positive 7. Their revenue growth is 26.2%, net profit margin is nearly 31%, and return on equity is over 32%. Those are fantastic numbers, Brooke. They are fantastic numbers, Ethan, reflecting solid past performance. But the second discussion about Meta was more critical, revolving around their reported investments in Google AI chips. Users debated whether Meta was pursuing TPUs because they were a strategic choice, or if they were settling for substandard chips due to a shortage of superior NVIDIA GPUs. That assessment was slightly bearish, a -3, because it suggests a potential compromise in their AI strategy. Analysts are split on Meta due to rising AI costs, and the stock is down almost 5% since its last earnings report, and quite a bit from its 52-week high.
See, I still lean towards the underlying strength. Those KPIs, revenue growth, net profit margin, ROE, are incredibly robust. Yes, the AI chip strategy is a big investment and carries risk, but if they successfully integrate cheaper TPUs, it could actually boost margins and scale their AI efforts faster. The 800 target, while ambitious, isn't completely out of left field if their AI initiatives pay off.
I agree that the core business is strong, and those are impressive numbers. But the market has clearly priced in some uncertainty, given the stock's performance since its high. The question isn't just about spending on AI, it's about whether they're spending effectively on the right AI infrastructure. This strategic pivot or compromise is a significant unknown that needs careful monitoring. So while I won't go full stay away given the fundamentals, caution is definitely warranted.
Fair enough. Balancing that long-term potential with the strategic execution risk, I think we can agree on a middle ground.
Yes, I think so. For Meta Platforms FXT, our AI-generated insight, considering both the strong core financials and the strategic AI infrastructure uncertainties, is a cautious buy.
So, to recap the day, hunters, here are our candidates for deeper analysis.
Investigate as buy. None. Investigate as cautious buy. Meta Platforms FXT. Investigate as speculative gamble. Intel Corporation. And that wraps up another episode of The Daily Hunt for Multibaggers. Quick disclaimer for all our listeners. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place and knowledge is your best asset. Thanks for tuning in, and we'll catch you next time on The Daily Hunt.